Hello everyone, this is Rob McDougall from Zhang Financial here with a weekly economic update. Today is Tuesday, June 3rd, 2025. As you may know, we normally do our updates on Monday, and our format usually is take a look at what the economic activity reported the prior week was, look at market returns, response to all that data, and then give you a preview of the next week's economic data. This week we're doing a little different. We've had a couple of client events in the last couple of weeks where we put together a slide deck just to give an update of where the economy is at this point. So not focusing on individual data points recently or coming week or so. So we're just going to go through that deck and take about 10 minutes or so. And the topics that we're going to hit, the positive and the negatives for the economy as we see it at this point. So we're going to talk about GDP growth, employment growth, inflation trends, interest rates, corporate profitability. Those are all neutral to positive, I would say positive. And then on the negative side, we have listed here tariffs on the slide. We're not going to touch that only because that changes so quickly by the time you watch us. There'll probably be some development that'll render it useless. So we'll just point out tariffs, big overhang, negative. If it goes away, you're going to see a huge rally. But for now, it's there, but we're not going to address it today. But then also we'll talk about, on the negative side, equity valuations and low consumer confidence. So before we start with that, we'll just take, again, inventory on a year-to-date basis, how the markets have done. So despite the fact we had a huge drawdown during the early days of the tariff spat that we've had, the equities are actually up in the U.S. now on a year-to-date basis. S&P 500, we'll just use that, up barely over 1%, 1.06%. That's favorable given where we were in April, and most would not have expected that. On the international side, developed markets have far outperformed the U.S. this year. We haven't seen this in a long time. I haven't seen it in 7 years. I'm not sure when the last time it's happened, but the first almost half of the year, again, S&P 500 up barely over 1%. Developed markets ex-US up nearly 14.5%, and emerging markets up 7.8%. The fixed income markets in the U.S. have responded very favorably this year. They were up quite a bit more a little bit earlier this year, but still at this point, the Bloomberg U.S. Aggregate Bond Index up nearly 2.5% through the first 5+ months. So, taking a look at some of the economic data. We'll start with GDP growth. This is the money ball. This is what really matters. GDP growth in the first quarter looks horrible. Negative. I think we have 0.3 here. It was revised up barely to a negative 0.2%. So would suggest maybe we're on our way to a recession, particularly given 2024 GDP growth was about 2.5%. But we'll just point out that first quarter GDP number that was posted, the negative 0.2%, had the largest drag from imports that we've seen. So the expectation, or I should say the hypothesis on this, is that U.S. companies, in advance of tariffs that they thought were coming up, bought in advance. So in that case, imports went up. In fact, imports were up 41% in the first quarter, year over year. So this all contributed, the tariff, the additional inventory buying, imports, was a drag of almost 5%. It was 4.8% drag on GDP growth. So we can't actually just add the 4.8 to the negative 0.2 and come up with 4.46, because obviously a lot of that buying that happened in the first quarter will unwind in the second quarter. But if we take a look at what the second quarter expectation is, put those two together, we should be pretty close to a run rate for GDP growth here in the first half. Now we're showing the Atlanta Federal Reserve slide. We show this virtually every time they make a change. And this was as of last week. They expected 3.8% GDP growth in the second quarter, which ends June 30th. However, just today, Tuesday, they have revised that up from that 3.8 to 4.6%. So if we take that 4.6% plus the negative 0.2 in the first quarter, just average the 2 quarters out, we're running somewhere in the low 2% GDP growth rate, which is actually a very solid showing. all things considered. Labor markets. Labor markets continue solid. Now, we do have a labor report coming up at the end of this week on Friday. Expectations are relatively low. We've been up around 180,000 for the last 2 months. The expectation is, for the month of May, we'll come in about 130,000, so we'll keep our eye on that one. Also on the employment side, unemployment rate, again, solid, kind of sticky. It's been at 4.2%. It's been a little bit lower over the last year, but this is the 5th month out of the last 12 that we've been at 4.2%. So the labor markets, we'd have to say, are solid at this point. GDP growth good, labor market solid. Inflation, this is a really good story. I kind of feel like it's underreported. PCE, personal consumption expenditure, that's what the Federal Reserve focuses on. They set their target. 2% is their target. Last month, it came in at an annualized rate of 2.1%, so just above the Fed target. And remember, here we are in mid-2025. 3 years ago, this PCE number was over 7%. So we're very close on the inflation front of being close to a comfort zone for the Federal Reserve that might allow them to cut rates later. Inflation expectations really hasn't moved a lot this year in total, but the expectation now is for 10-year inflation to average 2.3% over the next 10 years. In terms of interest rates, Federal Reserve, Fed meeting this month, June 18th will be the announcement. The Fed funds future market expect almost no chance Federal Reserve will cut. And these numbers are as of last Friday. The expectations built into the futures market, 78% probability that we're going to get at least 2 interest rate cuts or 50 basis points between now and the end of the year, and a much smaller, but a 38% probability that we get 3 cuts or more by the end of the year. Corporate earnings. This has been just a great story. First quarter expectation coming into the quarter, S&P 500 earnings growth would be 9% for the quarter. It came in 12.5%. Nonetheless, analysts have cut their expectation for full-year earnings growth for S&P 500, expecting some economic slowing that's tariff-related. So despite the very strong first quarter, the consensus expectation for S&P earnings growth for 2025 is 9%. I'll point out both 2026 and 2027 are at 13%. That hasn't changed. But earnings growth strong so far this year. Analysts are expecting some weaker results throughout the rest of the year. Now, one of the big issues brought up quite a bit about the market, equity markets in the U.S., valuation. Concern that valuations are stretched, given historical data, and that's true. So we're not going to argue that they're not. Definitely S&P 500 at 21.2 times, well above the 30-year average or the 20-year average or the 10-year average. It's high. However, the only thing we'd point out is part of that elevation is because of the Mag 7, call it the Mag 10, since that's what we have in our graph here. But if you just take out, if you look at those top 10 market caps in the U.S. by themselves, they're trading closer at over 27 times forward earnings. The other 490 names in the S&P 500 trading below 19 times, which is much closer to the historical average. So valuations are high, they're a concern, but for the rest of the market, X the Mag 7, X the top 10 market caps, valuation, no real cause for concern. Now, consumer confidence, this looks horrible. This chart looks horrible, and most of what I see in the press is consumer confidence has definitely taken a hit, and consumers just are a little concerned about the future of the U.S. Some of it is tariff-driven. I'm not sure what the rest is. Maybe the current administration, whatever it is, the numbers are pretty low. But a couple things here. One, we just got the May number. This is the University of Michigan consumer sentiment. It came in actually a little better than expected, flattened out. That's good, stabilization. But that is consumer confidence, and it will ultimately, if it stays low, it'll flow through to spending. However, we definitely have not seen that. So this chart, U.S. personal spending, we say it's resilient. January was a poor month, no question. We saw that in other metrics. So it was down, but then we had a nice rebound in February. March was really strong, and the April spending number also strong. So consumer confidence low, but the consumer continues to spend. And here is probably the best data point we've seen in a couple of weeks. U.S. personal income, this hit last Friday. Personal income on a month-over-month basis up 0.8%. And look at the last 3 months in personal income. What that's resulted in, more modest spending and increased income, is U.S. savings rate, which is historic. It's always low, a little bit embarrassingly low. Nonetheless, because of the factor income going up and spending moderating, we see the savings rate rising strongly in April of this year to about 4.8%. So that is it for our economic update for this week. A little bit different. Let us know if you like it, dislike it. If this is something that is helpful for you, we'll start doing this on a more regular basis. But thank you very much for attending. We'll look forward to seeing you next week. Thank you.